Good morning, everyone, and welcome to our class. This is a macroeconomics class, and today we are going to deal with the central bank and its functions here in Kenya. The central bank has a history, and that it was formed in 1966 after the dissolution of the East African Currency Board, which was concerned or which did entirely issue currency in East Africa. Remember, the Central Bank of Kenya is a monetary authority of Kenya with its head office located in Nairobi. The first function of a central bank is that it acts as a bank of issue. What does that mean? Remember, the central bank is the only body that issues currency, and therefore our point says central bank has the monopoly of note issue in every country. The central bank printed notes by the central bank are also termed as legal tender. Central bank has been given this exclusive monopoly of currency issue in the interests of uniformity. That means all should be uniform when it comes to features, size, and everything else. Better control, elasticity, supervision, as well as simplicity. The central bank also regulates the currency of a given country and the total amount of money supplied in that economy. That means an economy has a certain amount of money that circulates in its economy so that it can avoid what we call fluctuations and other things. Number two is that the central bank also is a banker, agent, and advisor to the government. Remember, for every government transactions to take place, or rather to happen, e.g. business conducted by the government, its ministries, it must have an account with the central bank. This is a centralized account whereby the government can deposit, withdraw, or even write checks against these accounts. And it facilitates for parastatal ministries, among other things that the government is paying. Therefore, the central bank everywhere performs the function of banker, agent, and advisor to the government. As a banker to the government, it makes and receives payments on behalf of the government. That's what I've just explained. And it advances short loans to the government tide over difficulties. It floats public loans and manages the public debts on behalf of the government. Also, it keeps the banking accounts and balances of the government after making disbursements and remittances. The third point is that central bank is a clearing house. That means banks offset their balances through the central bank. It acts as an organization that helps them have a platform where settlement is made by the payment of the difference. Also, the central bank, being a banker's bank, keeps the cash balances of commercial banks, and as such, it becomes easier for members banks to adjust or settle their claims against one another through the central bank. The fourth point is that the central bank is a controller of credit. Now, the control of adjustment of credit of commercial banks by the central bank is accepted as its most important function. Commercial banks create a lot of credit, which sometimes results in inflation, and therefore it has to be controlled, and this is done by the central bank. The expansion of or contraction of currency and credit may be said to be the most important cause of business fluctuations. The control which the central bank exercises over commercial banks as regards to their deposit is called the controller of credit. Right, commercial banks as well, central bank as well acts as the custodian of cash reserves. That means all commercial banks in a country keep a part or just keep some amount of money or their cash balances as deposits with the central bank. This is mandatory, everyone has to do that. Number two, they draw during busy seasons and pay back during slack seasons. That means that when the commercial banks are in need of cash, maybe the business is so booming and therefore they need some more cash to boost the business, they go back to the central bank and withdraw the amount that they kept as a reserve in the accounts which are held by the central bank. So other member banks look for it for guidance, help, and direction in time of need. Whenever they have a problem, commercial banks will go to central bank to seek their guidance, help, and also direction in their times of need. Finally, let's look at the central bank as the lender of the last resort. What means that the central bank can give cash to the member banks to strengthen their cash reserves position by discounting first-class bills in case there is a crisis or panic, which develops into run on banks or when there is a seasonal strain. Whenever the commercial banks have problems when it comes to financial issues, then the central bank can help them. They can lend them some money which will attract some interest. Also, the member banks can also take advances on approved short-term securities from the central bank to add to their cash resources at the shortest time. This is what we call overnight loans, where the central bank gives money to commercial banks, very short period of time, but remember they pay with an interest. We've come to the end of our discussion today. Thank you very much for attending this class, and I hope that you go ahead and do more research on the functions of the central bank so that when we meet next time, we'll just mention or just outline some of the findings that you get. Thank you very much. May God bless you. May you have a lovely time. Bye.